Hello, everyone, and thank you to Esperanza and the Acción Ecológica team, and thanks to ICIAM University for the opportunity to speak with you all and our think tank. So the Payne Institute for Public Policy sits inside the Colorado School of Mines. We primarily focus on energy security, the responsible production of energy, socioeconomic development from energy and mining, and Native American sovereignty. I run Payne's finance and markets research efforts that cut across the various initiatives. If there's a guiding principle to the work that I do, it's to seek a market-based solution to various problems. I'll sort of say it that way. And as Kathy mentioned, prior to joining Payne, I worked at investment banks for about 20 years in the oil and gas sector. So this morning, my colleague Duane Purvis laid out this very unfortunate reality that oil companies don't reserve funds to decommission their wells and reclaim land. Of course, this is very frustrating. I mean, all of us feel that way, but it is the reality that we have to work with. And he suggested that instead, the public in some way has to make up that difference, right? Has to pay for that fixing up of the land and the wells, or else the work just doesn't get done. So my objective today is to show the potential for what that means, because it's more than just governments paying money, or the Ecuador government in this case paying money. I'll provide a review of climate and environment-related finance as it relates to either nature protection or reduced production of fossil fuels. We'll discuss the scope of ambition and then a few specific financial mechanisms that have been used or at least are starting to be used internationally. And then I'll consider how those might be applied to ITT closure and Ecuador more generally. So at its core, climate or environmental finance is about monetary value being given to something other than just money, being given to something other than just pure financial risk and reward. There's a societal benefit that results from the activity that's being given some value. It's not conventional thinking, at least in the United States, or much of the northern, the global north, but that's the basic premise. It's a very simple principle, but it gets complicated really fast. So how much value should we put on a given activity? You're talking to a bunch of people that are used to thinking in terms of financial return. How do you put value on this? It has to reflect the contribution to climate or environmental good, but that's not so easy to evaluate or measure. And just because considerations other than money are included, the decisions by lenders or investors are not fully separated from those financial return conditions. Generally, there must still be the basis for loans to be repaid. That's just too hardwired into how money thinks. And so it sets a set of terms need to be established that value that, but within this context. So at the very least, projects need a revenue source or a cost-saving source that will support repaying a loan. And to the extent that the investment helps to foster economic opportunity in an area or in an industry, such that it can be reasonably expected to help foster independent private investment for the long term, so much the better. So much more the value that's being created and raising the odds that the loan can be repaid too. Another factor that can be considered and is considered is the scope of action in general. And this can be a huge range. Climate impact, environmental impact, can come from a single operation, such as closing down a coal plant or shutting in an oil well, or it can be countrywide. A very high-profile example of countrywide action is something called the Just Energy Transition Partnership, or JETP. These have been proposed in a handful of countries over the last few years. And as we'll get to in a couple of slides, a JETP is much more than just closing down fossil assets. It relates to a country's effort to fundamentally change its economy. there are important benefits to both the small scale and the large scale. For the small scale, the fact that it is simpler allows it to happen faster. It's much easier to figure out how it's going to work. It has fewer actors, fewer lenders probably. And the impact can usually be measured more easily, which, as I said, is valuable. On the other hand, seeking to make wholesale economic change, the potential for country scale impact is enormous. And for distinctly human elements like just transition, we talked about that a little bit without using that phrase today, it's really powerful. The decommissioning of an asset buys time for that asset to shut down some coal-fired power capacity and replace that electricity capacity with wind generation. Both the closure and the new builds were financed by a loan. The loan is to be repaid through profits earned by Engie, and Engie earns those profits by selling electricity to customers, as well as the cost savings, because it's much cheaper to operate wind power than a coal plant. So by bringing down the capital costs to build the wind power through a cheap loan, the savings overall helped repay that debt. So notably, Engie was offered as low as a 1% interest rate for a portion of that loan. I don't know what reference points many of you might have for that, but if I went out and tried to get a loan today, I'd have to pay 8 or 9 or 10% interest rate. So it was a much cheaper loan because they were trying to encourage, the lenders were trying to encourage this good environmental action. What was interesting about this transaction was that the rate was not set at 1%, but that was as low as it could go. If Engie did not act, or it did not act quickly, then the rate went up. And so they might have to pay 4 or 5 or 6% if they delayed shutting down the coal plant. So there was an incentive to act quickly imposed by the lenders. Now let me look at a different sort of example, one that's even closer to home. Ecuador has done 2 debt for nature deals. That's what it's called, debt for nature, in which the country commits to preserving natural resources in exchange for debt relief. Some sort of mechanism that they could pay less to their lenders. In this case, there is no commercial revenue source. The money is going to preserve nature. There's no cost savings opportunity. The money is going to preserve nature. Instead, a debt package was structured to save on debt service costs, so the government of Ecuador could pay less in interest to international lenders in exchange for some of that savings being committed to save nature. So in this example, the savings, $19 million a year, had to be put into a fund for 18 and a half years for the protection of nature. And some of that money actually had to be carved out separately so that it would last even longer. They'd build a fund that could be, sorry to get technical, it would get invested, money would come off of it, and that money would go to protect nature for even longer than 18 and a half years. So let me stress a couple things. First, it's very long term. The idea is that it's supposed to outlast a current president or a current administration. This sets a stage for longer term action beyond politics. The second point I'll note is in both of the deals, there was an independent governance structure answerable to the debt holders. In other words, the lenders said, we're not so sure we trust that this is going to happen. We would like an independent board that we can speak to that can prove to us that the money is being spent towards nature preservation. So setting that up was very important. Okay, I mentioned the Just Energy Transition Partnerships a few minutes ago, so let me spend some more time on that. So I mentioned that these envision remaking an economy. So it reflects massive ambition. And it seems to say something like, well, saying something to the rich world, the global north, something like, yeah, okay, we'll decarbonize, but on our terms. So we are not going to pass up this opportunity to leverage that process to support socioeconomic development in our country. So what's important to us is socioeconomic development. We get what's important to you is climate change, so we have some room to work. So in this slide, I provide a little detail on two JETPs. In South Africa, the government put out an official blueprint to spend $100 billion over 5 years, and maybe, this was an independent study, to spend $250 billion through 2050. The JETP was $8.5 billion. In other words, international governments were lending primarily South Africa only $8.5 billion. The idea was to take that, turn it into a massive investment in the country itself. I mentioned just transition. It includes explicitly, Transición Justa. That's $4 billion as part of the spending commitment on either retraining workers, in this case in the coal industry primarily, and helping them with the loss of jobs, with the loss of their livelihoods because of shutting down coal. So this concept of helping an affected community is absolutely understood and can be ingrained in thought processes and in these structures. Okay. Now I'll turn to carbon markets. Again, I mentioned this is a little different because it does not involve a loan. And so it's different from other climate finance. Now, I mentioned, I'm not sure I did. Should have. In the Engie situation, there was a very explicit value put on carbon, right? We talked about that in a sense. It was 1% as long as they acted quickly. What they did in that situation was they measured $1 per ton value for avoided carbon. And if you haven't heard this before, I know that's a big mouthful, and I know that's a lot, but the point is that idea that we can put $1 value on avoided carbon fuels all of the carbon market. So as it relates to shutting in ITT, the idea is sort of close to a specific type of methodology that tries to do the same thing. It's called leave it in the ground. And some of you have already used that term in different ways already. So I offer a couple of examples on this slide where there is a private developer who's trying to raise money to not develop an oil field. Not exactly to shut it in. Well, in one case it is. But for the EQX biome, it was to not develop it in the first place. So it's a mix. But these methodologies, although they exist on paper, have not been used. There's a lot to work out in terms of making it trustworthy enough for people to participate in them so that the integrity standards are high enough for people to trust that the value to the climate is what is promised. And in this case, the biggest challenge, I'm going to now complicate this discussion more, but relates to leakage. So leakage, for leave it in the ground, means, okay, we're not going to produce it at ITT, but somebody else is just going to produce that oil. The world is not going to use less oil. So what's the value? How do I put value on it? And that's what people in the carbon markets are struggling to figure out. There is some value, we can talk about it, but how much? And that's really the trick. If you can solve that, then carbon markets open to this exercise. Okay, so I've now reviewed a few different types of climate finance. Let's turn back to Ecuador. I'll spend a couple of slides and we'll think about the conditions for how to help finance closure of ITT. The upshot of what I'm going to say, and it's a little complicated, is that things are not as good as they were. Wait, did I talk about the Galapagos at all? I skipped over it. Oh, geez. Hold on. I'm sorry. I apologize. I skipped right over it. Forgive me, everybody. Okay. But I guess that's fine. Okay. So this is the debt for nature swap. Oh no, I did talk about this. Okay. I'm sorry. Again, I'm sorry. I am trying to look at English and do this, and didn't work so well. So let me come back to this slide. Please bear with me. Let me explain one idea that's important for this. So in the debt for nature swaps that Ecuador did in 2023 and 2024, both deals took advantage of the fact that international investors did not trust that your country would be able to pay back its debt. They just didn't trust it. And so what happens in that case is that debt which trades in the world's marketplace doesn't always retain the value. So if you borrow $1, but your lender doesn't think that you can pay it back, they might get nervous and they might be willing to sell that debt for something less than $1. And that's exactly what happened in Ecuador's case. So in the debt for nature swaps, the country took advantage of the idea that their lenders didn't trust that they could pay it back. And so they sold the debt for as little as 40 cents on that dollar, and were thereby able to replace. So they bought $1.6 billion back for $600 million. And they could save all of that debt service. That was the essence of the savings that they funded their nature preservation program for. So I hope that makes sense. But I apologize again for throwing us off on the order. So now if I jump ahead, the conditions like that are not as good today because investors believe more in your government's ability to repay its debt. So if you look at the blue line on this chart, the blue line reflects Ecuador. The other lines reflect other governments. And this is a concept called yield. But the point is that you see here, this is where Ecuador was in 2023, a 25% discount to other countries' sort of perceptions of themselves. Things have gotten better as investors have gotten more comfortable. And now that's not so different than a number of other countries. And so Ecuador does not have the opportunity to sell its debt as cheaply. It doesn't have the same opportunity to save on debt service the way it did. So, what do we have? Not as good debt conditions. We also have a world that's changed a bit. COVID made a big difference in how a number of lenders and governments thought about the world. There was also an awakening to climate change. and a spirit of willingness to give cheaper money to help countries combat it. And that spirit was where the JETPs were born and money was committed to. We are not in that same world now. Part of that is a function of my country's government. Part of that is a function of time and it's a little bit of, okay, Norway and all these other countries, you've made a pledge, now it's time for you to pay, right? And the country's like, oh yeah, I got to pay. Like they're not so excited about paying. So there are things that are just not as supportive as they were. And that's a shame because it'll make it a little bit harder, I think, for an Ecuador to structure something with the international community. That being said, I do hope that there are options that can be considered. Closing Yasuni, closing oil development in Yasuni, can appeal to biodiversity and social interests, clearly. It has no revenue driver. As I noted, there's less financial room to work with, and the environment's not as good. So in terms of framing, I think there are a couple of choices. A couple of options actually may surprise you, I think, but it's almost going bigger. The problems in Ecuador are bigger than just Yasuni, and so there might be a way to appeal to an international community by going bigger. So one way, for example, could be to address pipeline leaks, for example, at Sote. Now, many of you know much more about this than I do, but if the legacy of spills is in part related to climate change, global warming, more rainfall, more soil erosion, then this becomes climate adaptation finance. And there is an appetite for climate adaptation finance. And so you're balancing with Sote, you are investing in continued efforts around oil production, but at least you're making it much more responsible, much more effective natural protection. So you're wrapping in another thought. Another option to go bigger, again, I don't know how it's going to fly in this room, but I'll try it. It could include an upgrade of the Esmeraldas refinery. Again, many of you are more familiar. I'm sure my fellow panelists are much more familiar than I am with this refinery and the history of efforts to upgrade it. But there is a climate pitch to upgrading the refinery. It will produce oil with much less carbon intensity than it does today. It will also allow Ecuador to not have to export crude just to import products. There's savings on transportation, and the carbon impact of that is real. Meanwhile, upgrading and expanding the refinery actually creates a revenue source. So it gives something to repay the loan, like I keep stressing. So I think it was interesting. Like it's too premature to know if it's a good idea, but it just seemed interesting. And then the largest scale can be to emulate Colombia or a handful of other countries to consider countrywide decarbonization. Again, massive project,